Welcome back, traders. So today we're going to be talking about a time-tested trading strategy that is rule-based, that is very simple to execute, but that is extremely effective as well. It's the ORB, or Open Range Breakout trading strategy. So whether you're trading Forex, indices, stocks, or even commodities, this strategy helps you to find those moments of momentum with precision and structure. We all know that the opening range is a great time to get involved in the markets, but sometimes it's hard to know when to enter or exit a trade. Because this strategy is rules-based, as I mentioned just now, it really helps you to understand the market dynamics and then know exactly when to enter and exit those trades. Remember that Forex trading is risky and that most traders lose money. This video is for educational purposes only. So let's start with the basics. What is the opening range breakout? The opening range refers to the high and low prices during the first 10, 15 or 30 minutes when the market opens. And this could be any market. It could be the London Open, the Asian Open, or even the New York Open. So this strategy is basically where traders digest the news from the day before, they position for the day ahead, and then they react to the early volume. And there are three basic components to the ORB. Firstly, you're going to wait for that initial range to form. You'll draw a box around the high and low of that period. Then you'll only place trades if the price breaks out above or below that range in the direction of the breakout. So for example, if the price breaks above the high of that range, then it signals a bullish continuation, and so we go long. And if the price breaks below, it suggests that there is more bearish momentum, and so we'll go short. This helps you to avoid chasing early volatility and gives you a clear entry point. So why does this strategy work? Well, as we know, the open is often a time where hedge funds, institutional traders, and retail traders are getting positioned for the day, and where there is a high volume of trading taking place. And it's often the moment where the market declares its intention for the session. So you're letting the tug of war between the sellers and the buyers go, and then you join the winner on the way up or down. Now, I just want to talk about the core setup step by step, just so you get a clear picture of what it involves. I like to use the ORB on the 15-minute range, on the 5-minute chart, but sometimes the 30 if I see there's a lot of volatility in the market, as we're seeing now with the tariffs. So step one, you're going to wait for the first 15 minutes. You're then going to mark the high and the low of that 15-minute range. So you'll see the three candles form, and once that has happened, you're going to block out that range. So if the price breaks and closes above that range, you're going to go long. And if it breaks and closes below that range, you'll go short. You'll place a stop loss on the opposite side of that range, or use a percentage of that range. So you could use half the range as your distance for your stop, or you could use the full range as the distance, depending on the volatility in the market. Then you're going to manage your trade with a fixed risk to reward ratio. So this could be 1 to 1.5 or 1 to 2 or 1 to 3, depending on the momentum in the market and the volume of the trading going on. You could also trail your stop, which I also find is quite effective depending on the market. You don't want to do this in a ranging market, but in a momentum or trending market, this can be very effective. So if we look at this chart here, this is a trend day on the GBP USD. So the GBP USD opens and forms a 15-minute range, and this is roughly 40 pips. You mark the high and you mark the low, as you can see here. Then you see the price breaks above the high on strong volume at around 9:30, so you enter long. You put your stop loss 40 pips below your entry because that's the size of the range, and your target is at a 1 to 1.5 risk reward ratio. As you can see, about an hour and a half later, price pushes to your target and you caught a trend day. This is a textbook ORB strategy trading day. Next, let's look at a trade that was a little bit more undecided. So here's the DAX, and again, you mark out your range and you're waiting for a breakout. The price moves above by a couple of points and then reverses, and then later it dips below the low and bounces again. Now, this is what we called a failed ORB, or a range-bound trading day, which is not ideal for the ORB trading strategy. Now, if you had a buffer and you hadn't entered the trade as the price moved above the high or moved below the low, then you probably wouldn't have entered the trade and you would have stayed out for the day, which would have been a much better decision. And this is why filters are so important, and it's something I'm going to address right now. The ORB is not just a set and forget system. It's something that you have to monitor, and you have to look at the broad market structure, and you have to look at your settings to make sure it plays out effectively. So these are the key variables that you want to adjust for. Firstly is your opening range. Are you going to look at the 15, the 30, or the hour range? These are all various options depending on the volatility in the market and what you're seeing the market do. Next, you want to add a buffer. As I said earlier on the DAX example, if you'd got involved in that trade, you probably would have been stopped out and you would have got your position wrong for the day. What you want to do is you want to allow the market to move a few ticks above that long move or the short move before you take your entry. So for example, you could wait for the price to move 0.2% above or below that range before you take your trade. Another important part of this trading strategy is to look at your trigger window. How long do you wait before you take a trade? This may mean that you only take trades in the first hour of that session and then you don't take them after that, or you don't take trades after midday, for example. And this is because if a trade breaks out too late in the day, it's less likely to run. You're probably just going to get chopped around in that trade. Next, you can also filter for your stop loss options and change these variables to ensure more effective trades. So let's look at your stops. Obviously, you're going to be setting them at the opposite side of the opening range. And especially in these current conditions where the tariffs are wreaking havoc on the markets, you might want to set a wider stop. But then, of course, you're going to reduce your position size if you do that. Another way that a lot of traders look at setting a stop is looking at the average daily range or the average bar range and then setting a stop based on that movement. So as you can see here, the ADR is 40. So you may set your stop loss at 1.5 times the daily range. Next, if we look at the targets, as I said earlier, you may want to set a fixed target. So this would be a 1 to 1.5 or 1 to 2 risk reward ratio. You can look at the average daily range and make it double the average daily range depending on where you've set your stop loss. And you could make the target slightly wider if you find that it's a highly trending or there's a lot of momentum in the market. Then you could set a wider risk reward ratio. Another way to set your targets is to exit before the close of the day. So they allow their trades to run all the way to the end of the day and then just close them based on the time of the day. I also find this method quite effective, but it depends again whether you've got a ranging day or you've got a momentum day, a trending day. Trends will obviously produce much better results. Lastly, I just want to run through some pitfalls to avoid. This is also, of course, very important. Number one, don't use the ORB every single day. It's not going to work every single day. Look at the daily chart, see what's happening on the higher time frames, and then, of course, look at the news and various catalysts. Another one is not using a buffer. A lot of traders get faked out on minor price spikes. Then trading after the breakout window. I know I mentioned this quite briefly earlier, but have a set time where you're not going to take a trade no matter what the market is doing. Often the afternoon moves, especially if you're trading the London session, will prove to be fake outs. So try and avoid doing this. The fourth mistake is trading when there's no context or directional bias. So if you've looked at the daily time frame and you can't figure out what's going on, there's no clear trend happening, then you're likely to get stopped out in all the noise. Thank you so much for watching. If you enjoyed this video, please give us a thumbs up and please remember to subscribe to our channel, and I will see you in the next video.